Investors often look at equities as long-term investments with strong growth potential. However, equities can be risky. Rising equity markets can unexpectedly be subject to corrections and volatility. How can you capture market potential with protection? Introducing the Citi Dynamic Asset Selector 5 Excess Return Index, which seeks to effectively identify different market environments and dynamically adjust allocation between U.S. equities and U.S. Treasuries. Let's discuss how the index works. The Citi Dynamic Asset Selector Index chooses from just two asset classes, equities and treasuries. Equities are represented by the S&P 500 Futures Excess Return Index, and treasuries are represented by the S&P 10-year U.S. Treasury Note Futures Excess Return Index. By adjusting allocations between two assets that are not perfectly correlated, the index seeks to provide an improved risk-to-reward trade-off. The index then seeks to determine the appropriate allocation based on market signals. Each day, equity performance trends and volatility levels are used as signals to determine whether the market environment is low, medium, or high risk. A low-risk environment is identified if there is an upward performance trend and low volatility. In a low-risk environment, the index will be allocated 2/3 in equities and 1/3 in treasuries, seeking to benefit from a larger allocation to equities when a positive environment is identified. A medium-risk environment is identified if there is an upward performance trend with high volatility or a downward performance trend with low volatility. In a medium-risk environment, the index will be allocated 1/3 in equities and 2/3 in treasuries to take on a conservative allocation when market signals are uncertain. A high-risk environment is identified if there is a downward performance trend and high volatility. In a high-risk environment, the index will be allocated 100% into treasuries to mitigate risks associated with equity investing in a high-risk environment. A change in environment can be identified as often as daily. If there is no change to the environment, the allocation will remain the same until a new environment is identified. Why should you consider this index? First, the index provides a systematic approach to investing, as the index rules and allocations are pre-specified. This can prevent emotional biases in investing. Second, the index also provides a dynamic allocation to capture market potential by using just two assets. Finally, the index seeks to provide risk management and rebalancing features to smooth the impact of drastic up and down movements in assets to provide a more stable return. For more information about the index and related risks, please refer to the index guides and relevant offering documents.